N8 Invest DFM Future Focus webinar of 2023. So great to see so many of you on the call this morning with a fascinating topic, I promise you, a little bit later. So Future Focus is a series of webinars focused on understanding the world of fund managers and comparing and contrasting the best investment management skill, not only in South Africa, but globally as well. And we cover the most important topics affecting investment management today, AI. Just a reminder that your DFM team won the Citywire Awards for Best Performance in 2022, where we competed against about 20 other DFMs in South Africa. So rest assured, your solutions are managed by one of the best teams in the country. We pride ourselves with our investment pedigree, our institutional power, and most importantly, our partnerships with you, our wealth planners and financial advisors. Our role is to empower you and your practice by generating investment alpha and creating practice alpha so that you can unlock your advice alpha for your clients, right? So we see that as our value promise to you as a DFM. So for those of you with co-branded and customized solutions, as you know, we've been through your personalized investment oversight committees with your dedicated portfolio manager. We've got an action-packed session today, kicking off with Carl Chetty, portfolio manager at the DFM, will give us the latest performance overview of the N8 Invest core solutions. And then as a reminder, in February, in our first discussion, we discussed multi-asset funds and the possibility of a looming global recession in 2023 and the implications thereof with Granite and 91. Today, we discuss artificial intelligence, a topic that couldn't be timed better with global news headlines this morning, all focusing on sort of quite sensational comments made by tech leaders on the future of AI and the impact on mankind. But we'll focus on investments. With the increase in adoption of AI technologies, investment managers are consistently and constantly searching for new ways to leverage AI to enhance their decision-making process and drive better returns for clients, right? So the question is, will AI eliminate the need for human asset managers, or is the future one where it's augmentation of man and machine to combine to make better investment decisions? So we're honored to have Dorian Corral of Schroders and Gotham Samath of M&G, both AI specialists and seasoned portfolio managers as well. We'll also be joined by Maurice Oberholzer of Standard Multi-Strategy Franchise to discuss the topic man versus machine. So some fascinating stuff. We'll then be joined by Wasim Abrams, our head of distribution, who will host Evan Bars. And many of you know Evan of NMG Research will be sharing his insights about what's happening in both the local and global investment advice industry. So really great insights that will come out of Evan's discussion with Wasim. So from a housekeeping perspective, if you have any questions, please feel free to pop it in the Q&A box. We'll definitely try to answer it. And if not, we'll get it to the relevant people and hopefully we can get those answered questions back to you as soon as possible. We will be applying for CPD points for the webinar, so please keep an eye out for the notification. The webinar will be recorded and available in the next few days, along with the slides that you'll see during the next hour and a bit. So this is going to be an action-packed session, as I mentioned, and without further ado, I'd like to welcome Carl Chetty. Carl.
Great, thank you very much, Lee. And a very good morning and a warm welcome to everybody on the call. So I'm going to kick off with a brief overview of the performance of markets in the first 4 months of the year. I'll then talk through the performance of the N8 Invest core range of model portfolios, and I'll wrap up then with a few points on how these portfolios are positioned in the current environment from an asset allocation perspective. So kicking off with markets on the first slide, it's been quite a bumpy ride this year, particularly in the first quarter. You know, markets began the year on a positive note on the back of China reopening their economy after their prolonged period of COVID lockdowns, as well as US inflation showing signs of cooling and markets also beginning to price in interest rate cuts for the back end of 2023. But the positive sentiment reversed in about early March when the fast rising interest rates we've seen in the US initiated the collapse of a few smaller regional banks, and those were namely Silicon Valley Bank, Signature Bank, and First Republic Bank. And that initially caused quite a sharp decline in stock prices, but the Fed intervened to guarantee all deposit holders, also to pump some liquidity into the financial system, and that saw equity markets recover their early losses. And then we also saw a host of big tech companies release earning results during March and April, and they were generally ahead of market expectations, and that also saw tech prices rise quite strongly. So the chart on this slide shows the RAND performance of the major asset classes and also the ASISA peer groups, the main ASISA peer groups for the first 4 months of the year. And we can see that global assets in the light blue bars here, they were the best performers, and that was mainly due to a 7.5% depreciation of the RAND against the dollar. But even in dollar terms, global asset classes performed quite well. But I must note that the good performance of global equities, it's largely been driven by the big tech names such as Apple, Amazon, Alphabet, Netflix, Meta, Microsoft, and Nvidia. So the returns haven't really been broad-based. And then on the local side, in the dark blue bars, our local asset classes have delivered fairly pedestrian returns this year, and that's due to mainly to the deterioration in our growth outlook as a result of persistent load shedding. Now, the decent 6% of the CapSwix index return that you see on this chart, that was mainly driven by large cap multinational shares like Naspers, Prosus, and Richemont, and they've benefited from the China reopening. The SA Inc. component of the index has generally struggled this year. And then looking at the 5 ASISA categories in which our DFM portfolios play in, the returns have been fairly decent across the board. The green bars represent the average return achieved in each category. And funds with higher offshore exposure would have performed relatively better than these numbers, while funds with higher SA exposure would have done relatively worse than these numbers. On the next slide, I just want to quickly show you the 1-year returns to the end of April, with a sort of pink dashed line representing the SA inflation rate at 7.2%. And it's a similar sort of story. It's really only been your global asset classes that have delivered an inflation-beating return over the last year. Although the CapSwix marginally outperformed inflation, that was largely driven by large cap multinational industrial shares. If you look at resources, they were actually negative with a return of -5%, while financials were flat over the last year. And then in terms of fund performance, the income category in the green bar, that underperformed CPI. Your low, medium, and high equity categories marginally underperformed, while the worldwide flexible category delivered a return of about CPI plus 4%, and that's due to its higher offshore exposure. Moving then on to the performance on the next slide of the 5 Innate Invest core portfolios. The table on this slide shows the returns of the models to the end of April, net of all investment management fees. We launched the models on the 1st of January 2022, so they've got 16 months of live performance history at the end of April. Prior to the 1st of January 2022, we calculate indicative backtested returns, and so the 3- and 5-year numbers we're showing on this table include a combination of live and backtested performance. Zooming in on the since inception returns on the far right column, you can see that all 5 of our portfolios are well ahead of their respective benchmarks. The key contributors to performance over this period has been our allocation to boutique flexible funds, which we use across the range, barring the flexible income portfolio. Each one of our portfolios includes a combination of Bateleur Flexible Fund, Laurium Flexible Fund, Truffle Flexible Fund, and 361 Flexible Opportunity Fund. And these managers have generally added really good value, primarily through actively managing their asset allocation through various risk on and risk off periods, and also through good security selection across the various asset classes they buy in their funds. The portfolios also have a longer term CPI plus return target. Although our portfolios don't really, have a long-term history as yet, we do show 5-year numbers here, which include a portion of backtested returns. But you can see on the 5-year column, the models have demonstrated an ability to hit those CPI plus targets over a sufficiently long period of time. Then looking at the year-to-date returns in the far left column, despite all the negative news flow so far this year, all 5 portfolios delivered very decent returns on an absolute basis, and that was really due to great returns from offshore assets as the rand weakened by close to 8%. On a relative basis, the income portfolio and the growth portfolios were ahead of benchmark, while the stable growth, moderate growth, and high growth portfolios marginally lagged. In the next slide, I just want to unpack some of the key contributors to performance from a manager perspective on a year-to-date basis. And the first fund I'm looking at is the Amplify Strategic Income Fund. And that's a fund managed by Terebinth Capital under the leadership of Eric Nell. And he's a very well-respected and experienced fixed income manager, particularly in the institutional space. We use this fund in our flexible income portfolio. It had a very strong quarter on the back of its overweight position in longer date fixed rate government bonds, which did quite well. It ran a duration of about 2.7 years, and that's quite a bit higher than the other 5 income managers we use in the income portfolio, who are all running durations of less than 2 years. Coronation Balanced Defensive Fund had a strong quarter. It outperformed peers by close to 1.5%. We use this fund in the stable growth and the moderate growth portfolios. And again, the outperformance was mainly driven by the fund's large overweight position in offshore assets. So it runs an offshore exposure of about 22% over the period. That's double the average low equity manager at 11%. Then 91 Opportunity Fund, which we hold in the high growth portfolio. That was actually one of the best performing high equity funds in the category in the quarter, with a return of 9.5%. And again, that was driven by the fund's large overweight exposure to global equities, sitting at around 35%. And that compares to the average high equity allocation of just 20%. And the fund also holds no positions in local listed property, and that was a contributor to performance. The 2 key detractors on a year-to-date basis on the next slide, those were Truffle Flexible Fund and Laurium Flexible Fund. Both funds, although they delivered positive returns, they've lagged their peers in the multi-asset flexible category, and they were really mostly hurt by by their overweight position in resource stocks. They were also negatively impacted by their overweight position in banking stocks. So that was on the back of the mini banking crisis in the US. Truffle, for example, has its top equity holding as Absa Bank, so that was a detractor over the period. The longer-term track record of both funds, though, remains quite exceptional, particularly Truffle, which has delivered a similar return to local equities over the last 5 years, but with a lot less risk. So the unconstrained, tactical, style-agnostic nature of our flexible funds remains a key return-enhancing and risk-reducing allocation in our model portfolios. And then lastly, on the next slide, turning to our positioning from an asset allocation perspective. As a first comment, it's important to bear in mind that when we construct portfolios, we use multi-asset funds, which we've actually selected on the basis of their skill in both asset allocation and security selection. So the overall asset allocation of the portfolios is really driven by the combined views of our underlying managers. The exception is the flexible growth portfolio, where we follow more of a hybrid approach, and we use both multi-asset funds and single asset class building block funds. And that's because the funds in that category, they tend to hold too little exposure to equities on average to get to a CPI plus 5 to 6% return over time. So we've topped up the equity exposure using pure global equity funds, and that gives us a better chance of getting to the CPI plus 5 to 6% return over time. So what you see on this slide on the left is the allocation to total equity, and on the right to total offshore. The total equity allocation that goes from about 30% in the stable growth portfolio right up to about 75% in the flexible growth portfolio. And that's slightly below the longer term averages because the managers are generally a little bit more conservatively positioned in the current environment. And in terms of the offshore exposure on the right, that ranges from about 3% in the income all the way up to 65% in the flexible growth portfolios. And these allocations are actually a little bit higher than they've been on average in the past. And that's because of the new 45% offshore allowance for Reg 28 portfolios. So we're seeing our managers slowly increasing their offshore allocation, but they're not rushing to get to that 45% mark just yet, because generally they still think that local assets are more attractively priced than offshore assets, but we expect a gradual increase towards the 45% mark over time. So yeah, thanks, Lee. That's it from me for now. Thanks to everybody for listening, and thank you also for your support.
Thanks so much, Cole. Great to see that the portfolios are doing well. Yeah, in a really tough time. So guys, next we move to sort of the meat of our discussion today. But before we do that, I'm going to introduce you to 3 of our panelists, and they'll have 5 minutes or so just to chat a little bit about their views on the particular subject and their businesses as well. So first up is Dorian Carell, who is co-head of multi-asset income at Schroders. He joined Schroders in 2003 and is based in London. In 2017, Dorian joined the Global Multi-Asset Income team as a fund member with particular responsibility for multi-asset growth and emerging multi-asset income strategies. He's the head of the credit team of the Strategic Income Group Multi-Asset, or Sigma. Prior to this, Dorian was an analyst on the global equity desk in London before becoming a convertibles fund manager and analyst based in Singapore and Zurich. In 2000, prior to joining Schroders, Dorian was head of research and statistics at the Investment Management Association. From 98 to 2000, he was a risk consultant at Ernst & Young. He's a CFA chart holder. He's got an MA in politics from Edinburgh University and IEP Grenoble. So Dorian, thanks for joining us. And maybe just as a background, we hold the Schroders Multi-Asset Income Fund in our global cautious portfolio. Thanks, Dorian.
Fantastic. I feel so old when you're going through that roster of history there, which I'll quickly forget. I think if we move on and take the focus away, I'll come back to the man versus machine in a minute, and we move on to the next slide. I just wanted to highlight the team. As you said, we manage an income fund which feeds into your products, but we manage a spectrum of funds, the team that you see in front of us, in front of you there. So from a defensive income prioritizing fund, which is on your platform, to a punchy kind of thematic version, which blends converts and equities and bonds. But also we have an emerging market and an almost obligatory sustainable fund. The person I'd really like to highlight here, though, is Jingjing Cui, who's on the sort of bottom right of the four fairly terrifying pictures that you have in front of you. And Jingjing is the person who puts together our thematic sub-portfolios for the income strategies. So she uses AI to define her universes and works with someone called the Data Insights team and various other teams. And her background is a quantitative analyst from the equity team here at Schroders and JP Morgan before that. So there is a sort of embedded person. And I think this is something that you're going to see as you go through the next 6 months, 12 months, that almost all teams have someone, at least one person. I know M&G have a dedicated specialist that will be talking after me, but at least one person on the team will be tasked with looking at this area. And we think within multi-asset that the best use of AI is to pull together sub-portfolios and then test them with the fundamental analysts and use them as ingredients of our strategy. So if we move on, with that in mind, to slide 3, we've literally taken the ingredients idea very literally here and put together an income menu for you. What we tend to do is think of this in terms of the home currency of the investor. So the strategy that we're talking about today is a dollar-based strategy, but obviously you could do the same in South African Rand as well. And on the left, you have the old favorites, the core, we think, of any multi-asset income strategy. And here, what we've tried to do with the dollars is to explain whether things are expensive or cheap. So obviously, the more dollar signs you see, the more expensive things are. And here, high yield is kind of at the expensive end. But what we've also done is incorporated AI. So you can see there that we've got AI beside US equities. And as the commentator earlier was talking about, the market in the US has been extremely narrow. And it's been driven by a clutch of mega cap tech companies initially because their earnings were very strong and they were growing faster than the market, having had a disastrous year last year in market terms. But also now, obviously, driven by NVIDIA, driven by the AI, what might be termed the peak of inflated expectations. There's a series of terms that I think would be interesting to discuss maybe later on. But if we swing to the right of the menu, you can see that AI comes through in the portfolio in semiconductors, and that's something that we think differentiates what we do. We've been overweight semiconductors in the portfolios for about 6 months now, based on a cyclical view and an AI driver. And also Japanese equities, probably not a typical ingredient that you would see in an income strategy, certainly not for the last 30 years. The topics has just gone to all-time highs for the first time in 30 years. And secondly, the valuations are incredibly compelling, both on a yield basis, 3% yield, but also on a price to earnings. So quickly, if we move on, just to wrap up, we therefore have quite a skew. And we would say that this is influenced by the way that we see the world changing, both to the US, which is not typical for an income fund, and to Japan. And within the US, and a subject that I think is pretty important, we do expect the mega cap tech to continue to do well. And we do expect that AI does have a concrete effect on the market going forward. So there's a slightly contrarian views in many ways because people hate the narrowness of the market, but we think the risk is that it carries on, combined with cyclicals, which we think will do better. And then finally, just onto the next slide, you can see here that on the right-hand side, that AI really does color what is a defensive income portfolio, with Microsoft being the top holding, NVIDIA being number 5. On the right-hand side, you can see the top holdings of the fund, but just to the right of that would be the classic dividend approach, Johnson & Johnson, Procter & Gamble. We do not have high weightings in these stocks. Similarly, just to finish, on the left, tech is 15% of the portfolio. That's not something you'd expect. So in other words, we think AI and technology, machine is beginning to dominate here, certainly in terms of productivity, in terms of growth, but critically in terms of market performance, we think, going forward.
Fantastic. Thanks, Dorian. So, I mean, what I hear there is not only invested in technologies supported by AI, but also using AI in your processes, and we'll discuss that a little bit later. So next, I'd like to introduce Gautam Samath. For those of you who attended the investment forum earlier this year, Gautam was on stage in Cape Town and Johannesburg speaking about AI specifically and the impact of AI investment on investment management. So I thought it'd be great to invite Gautam to this discussion. Gautam is a portfolio manager at NMG Investments and joined the investment team in UK in 2014 as a dedicated analyst on the M&G Leaders team, and became deputy manager of the Global Leader strategy on the 1st of April 2016. He started managing systematic equity strategies in August 2018 and is currently the head of systematic investment strategies. He's the portfolio manager of the M&G Global Equity Fund. Prior to joining M&G UK, Gautam worked for Credit Suisse in New York, where his last role was vice president in the HALT investment strategy team. Gautam graduated from Trinity College in Connecticut in 2009 with a BS in economics and Chinese language minor, and is a CFA charter holder. So before Gautam starts, where we hold in our local portfolios the M&G Inflation Plus, M&G Balance Fund, in the offshore component, this is where specifically Gautam and team and their capabilities are used within those portfolios. So thanks, Gautam.
Thanks, Lee. And thanks for having me. I'm extremely excited to be over here. AI is a topic that we're very passionate about at M&G. I know the news flow has been rather recent with, and we have to thank ChatGPT and OpenAI for actually spreading the word of AI, more specifically machine learning. But actually, we've been working on AI-based investment strategies for a very long time over here at M&G. So our journey started when we built our first version of our model back in 2016. And since then, we've developed multiple new versions of the model. So we're on our 5th version. We come out with a new sort of update or a big sort of platform change every year or so. And alongside that, we've grown our investment teams and our infrastructure, and we've been running live money on AI-based investment strategies here at M&G since 2018. We launched our first external usage vehicle in December 2019, and as of today, there's over $600 million invested in this strategy. So it's not just a pipe dream. This is here and now and live, and pretty significant in our opinion. And while the technology is great, and it'll continue to improve alongside better compute, more data, smarter algorithms, I guess in keeping with today's discussion, you can't really downplay the role of human beings in the process. And this is true for all stages, whether it's at the very inception of building these strategies from the design stage. So what do you want your models to learn? What do you want the systems to learn? What do you want it to not learn? Those are big, important decisions that human beings need to make. Even the database that you curate, we're always adding newer data sets with richer histories and more granular information. What we choose to input into those databases has a very important role in what these models can then see and predict. And then, of course, what algorithms do you use? How do you fine tune them? And then how do you eventually take the outputs of these algorithms and then use them in order to build portfolios of stocks? All of those are steps that require careful human supervision. And you really need fundamental know-how, but also domain expertise. And that's where we're able to leverage the vast breadth of M&G's global fundamental capabilities. So we have investment teams over here in London, in South Africa, in Chicago, in New York, in Hong Kong, in Singapore. We really have a global presence where we can leverage our capabilities in a pretty unique way. And the importance, if you go to the next slide, of that capability, if we can switch to the next slide, you can really see how that comes forward in our stock selection process. So we don't just use the outputs of our model blindly. Every recommendation that comes out of our models then goes through some deep checks. So it's first checked, every recommendation is checked by the fund management team, myself, the team that sits over here in London, and we're looking for areas where the recommendation might be tripped up because the data might not be right, or there might be something happening at the industry level that the model might not know about. And then we also leverage the M&G equity analyst capabilities. They have deep sector specialty. They know what's happening intricately with the stocks, but also the industry. And we're looking for red flags. And the reality is, we generate these live predictions on 10,000 stocks globally, right? So we're pretty happy to drop one stock if there's a particular red flag and take the next best alternative. And that's a capability that you just don't get. That scale, that automation, that live comparability, but then also the fundamental overlay. That combination really produces the results that we see. And of course, there's only one true test when you build these AI investment strategies, or any strategy really. And how does that work in the real world? So if you go to the next slide, the last 3 years have been a pretty good test of any investment strategy, really. 2020, we saw a pandemic. We saw a world in which we had a pretty big sell-off and then a pretty remarkable recovery. And within styles, we saw growth stocks outperform significantly and value stocks went nowhere. 2021 was more of the recovery trade. We saw broader participation, but value stocks made a bit of a rebound. And then while both of those years had seen significant up markets in equities, last year was actually one of those where you had rate pressures pressuring all asset classes, equities down, and a bit of a regime change in that respect, with value significantly outperforming growth. So there's three very different environments. And what's pleasing is that we were able to build robust models that were able to outperform in each one of those discrete years. And so it gets us to a point where on a cumulative basis since inception, we've outperformed our benchmark by close to 2.5% per annum after fees. So while we're only getting started, it's quite an encouraging result when you think about what we've been able to achieve, building AI models, combining them with humans, and then developing strategies that can be robust across different regimes.
Great, thanks, Gotham. I'll invite you back to when we started the discussion, and then lastly we have Marius Oberholzer. Marius is head of the Stand-Up multi-strategy team, and Marius joined Stand-Up in September 2013 as co-head of Absolute Return Strategies. Marius then took over as head of Absolute Return Strategies in September of 2015. Marius joined Stand-Up from Sorala Capital in Cape Town, where he was a managing partner responsible for providing strategic direction for the firm. His role was focused on corporate finance solutions and spearheading the group's unlisted investment activities. Marius holds a BCom degree from Stellenbosch University and an Master's in Science in Global Finance from Stern School of Business in New York University and the Hong Kong University of Science and Technology. He holds the IMC UK investment qualification as well. Quite a mouthful. Well done. And thanks, Marius. Marius, you're on mute.
Hi, Lee. Thanks for that intro. I don't know if those letters mean anything. At the end of the day, it's all about what you deliver for your clients, and we're working hard on that. So good morning, everybody. You've heard some stellar experts so far talk about AI, and we'll go into that in a second. But maybe just for those who haven't met me, hopefully many of you have met either me or members of the team. So I run the multi-strategy team at Stanlib, fairly senior team. Average experience around 17 years in industry experience, and we deliberately built this team from its evolution in absolute return strategies, morphing into hedge funds, and then more recently into these multi-strategy portfolios that we manage fairly large scale. You can see on the left-hand side, we're managing around 114 billion rands worth of assets across a variety of strategies. I think the interesting part, which has been touched on by Dorian especially, is the build out of the team. It was very clear to me very early in my career that technology was going to make a massive impact, not just in terms of how people make decisions, manage portfolios, access data, but coming from a trading background in a hedge fund. Ultimately, the speed of execution mattered, and we saw that in the high-frequency trading environment made popular by Michael Lewis's book, Flash Boys. But algo trading was de jure. It was something that we did as far back as 2003, 2004, and we've seen an evolution of the use of technology across investment capabilities. And the rise of quants and more recently into AI strategies, which I think is a natural evolution. So we hired Muntu Madwara, who rejoined Stanlib, Michael Streetfield, or Dr. Michael Streetfield, who's a data scientist, and more recently David McNay, who's an astrophysicist by training, but deep experience in portfolio management internationally, with a high degree of coding capability and the ability for these guys to build data sets for us to improve our decision making. Of course, it is very much our view, and I think you'll hear the panelists talk about this a little bit later, in that information is one thing, making decisions is slightly more different, and I don't think we're quite at the point around pure decision making being driven by black box approaches. I don't think investors are ready for it, and I certainly think that there is a place, which Lee will ask me about a little later, I'm sure. There is still a place for human judgment to be made, but clearly we believe in the benefits of technology, and we're trying as a business that stands for being progressive in the South African landscape. We are working hard as a wider business, Radame in our systematic solutions business, clearly focused on quants, and more recently moving into AI. We've done a huge amount of work in upskilling our total business through coding in Python and R, and spending an enormous amount of capital investing in our business to make sure that our data sets have the integrity, are clean, that we can utilize those for the benefits of decision making and ultimately for the performance of clients. More recently, we announced an incredibly large investment into the BlackRock Aladdin system. That will help us with decision making, collating data, having it at the portfolio manager's fingertips to really help us speed up decision making for the better. Speed kills, so you need to make sure that the information you're using is correct, and some of the dangers that maybe Lee touched on in those headlines that we heard this morning need to be kept front of mind. But we've built out this business fairly carefully in terms of the capability and the type of capabilities we want in the team. And of course, many of you will know that the Stanlib strategic partnership with JP Morgan Asset Management, my team specifically have been very much involved in that, and we've been working with that team in London for nearly 4 years now. But just to give you an idea, I mean, on that trading desk in London, the number of data scientists far outweighs the number of execution traders that are deployed to help augment decision making from a trading perspective, as well as in their beta strategies. And clearly, given our strategic partnership, we have access to those capabilities, both from a learning perspective, from improving our own models and testing our own hypotheses. So I think we're trying to be at the forefront of progressive asset management, not just as a business, but certainly in the team that I'm privileged to lead. And I think we have many of the capabilities that we need to succeed in that. So hopefully it's not just a dinosaur talking to you here. We very much believe in what's happening. And I think interesting, when I first met Lee, it was probably 5 years ago that we sat on stage talking about this very topic. And I made a joke that lots of people talk about it, not many people do it. The world has moved on very quickly over the last 5 years or so, and certainly has sped up with ChatGPT coming to fruition. But AI has been around for a long time, but clearly now very much in the public mind, in the corporate's mind, and something we'll chat about in a second. Thanks very much, Lee.
Awesome. Thanks, Maurice. Yes, it was about 5 years ago on a investment forum stage, if I remember correctly, chatting about this very topic, the impact of AI on investment management. And clearly, it's a lot more real than it was back then. So I'd like to welcome everyone back to the discussion now. So Marius and Gotham and Dorian. And Maurice, let's continue with just having you speaking here quickly and to paint the context here. So markets have been crazy over the last 12 to 18 months, right? So new information is hitting us at rapid speeds. As human beings, is it just too much for us to process? Do we have the capacity to take it all in and make good investment decisions?
Yeah, Lee, I mean, a great question, and I think Gotham and Dorian will agree. The last few quarters, last year, 18 months or so, has been something of a challenging environment. I think it's not been as challenging over that 18-month period as it has been over the last 6 or 8 months, where the data has not, or the market reaction to data has not been what we've observed historically. I think it was quite easy at the beginning part of 2022, given the comments from Powell, for instance, around inflation no longer being transitory, telegraphing rate hikes. We had the war, which, if you were watching the wires and keeping your finger on the pulse there, was clearly going to be a big thing if Russia went into Ukraine. Some of those spillover effects, much more difficult to really get your arms around. And then the China COVID lockdown, extension of that lockdown, and the behavior of its citizens subsequently as they've come out of that lockdown has been interesting, and Dorian touched on that in terms of the reopening trade and etc. So I think it's been challenging. I don't think it's been that difficult to focus on the things that really mattered. And I think this is where AI is potentially problematic, is that it creates a lot of information flow, creates a lot of noise. And the job of investors like the three of us and our teams is really to filter through that noise to work out what is signal. We've done pretty well in our funds, predominantly not through maybe capturing all the upside opportunities, but really avoiding the things that potentially could hurt our portfolios, and it's led to pretty substantial performance relative to the peer group, certainly over the last 12, 18 months or so, and over the last 5-year period, which is something that we pride ourselves on. So I think it's been difficult, but clearly if you've got a team with diverse insights, capturing information from different perspectives, and let's not forget, Stanlib is a big machine. We've got these specialists that we are able to access, draw on their expertise, and we work hard as a business, and we're getting better at it. Historically, we maybe not as we've not done it as well as we are doing it now. But clearly, the ability to pipe into these different teams, including JP Morgan, where it's an investment relationship first, not a distribution relationship. Those things help us distill the world. But I think the real answer to your question, as far as I would answer it, is it's important to make sure that you're not reacting to all the information, that you are able to separate signal from noise.
Great. Dorian, let's start with the basics, right? Let's get into this AI topic. So AI seems to be a catch-all for all modern technology nowadays. There's also machine learning, a sub-branch of AI. When we talk about the impact of AI on investment management, what are we in fact talking about?
Yeah, I mean, you can start with algorithms, which are basically a set of rules for solving calculations, solving problems. And if you look at the kind of algorithmic funds, the machine is really dominant this year, and it's really below the surface. So if you look at what's happened in terms of performance, fundamental investors have been stepping back, they've been cautious, it's been a very challenging environment, they've been underweight equities. And frankly, that's been wrong. Whereas the machines, it has to be said, have gone the other way so far. So they have been overweighting equities. And you can see with the NASDAQ up 24%, despite the problems that people have mentioned, despite the fact we've had the debt ceiling problem, despite the concerns about regional banks. And the question is what's happening? And it's basically a subset of funds. So it's quant funds led by Risk Parity or vol control, which might feed into the previous commentators' kind of world, which have done very well. And they've tended to increase equity exposure because volatility has been quite low. And that's something that fundamental investors have just missed. And this has been magnified by CTAs, which are basically trend followers. Again, following an algorithm, which kind of leads you into AI, if you like. It's the genesis, the starting point. And so they have got on the train, and fundamental investors have been left very confused. So if you were just to take the first 4 or 5 months of this year, machine has clearly totally dominated that. And so the question is, from here, is that likely to continue to be the case? I'll leave you with one final stat. 30% of the hedge fund industry is now quant, rule, or algo based. And you can see the algos developing into the AI world. I would say that will go up to 40, 50 and beyond. So it's a massive challenge.
Fantastic. I mean, look, great insights. And maybe next question then to you, Gotham, just based on that. I mean, we've already seen, as Dorian mentioned, the impact of AI on the hedge fund industry. But is it possible for the machines to take over investment management sort of decision making completely? Will there still be a need for traditional portfolio managers in the future?
Yeah, I mean, so let's go back to the fundamentals of what these algorithms are doing. These algorithms are primarily machine learning focused, which is a subset of AI. And what they're doing is they're extracting relationship in underlying patterns and subsequent outcomes. So typically, in order to find these relationships, they're relying on historic data, right? So you're looking back in the past of the financial markets and you're trying to understand the relationships associated with underlying structured data. So, pricing, volatility, fundamental data, and subsequent share price performance. Now, to the extent that the future looks a lot like the past, then these algorithms will be very good, more efficient than human beings at extracting those patterns. But I'll give you an example last year. So CTAs were doing very, very well until the end of October. As rates rose, they got on to those trends really quickly. And then actually, if you look at the CTA index, it did astonishingly well. But what happened was you had this point where steepening of the yield curve in the US got to a point where you had essentially restored a decent amount of value. And then you had a bit of a rally, both in risk in the long end of the curve, but also risk assets like equities. And they got completely caught on the wrong side. These changes, you can get more clever at change point detection and those kind of things. But these changes, either they're small sort of shifts in the macro backdrop, or bigger changes like regime changes, are much harder for machines to predict, and you can get caught offside over there. So there will always be a role for human beings, primarily because the number of examples of regime changes that you have in financial markets are not enough for machines to learn them. So when you're learning from 10,000 stocks on a daily basis, going back 25 years, yes, stock selection is a pretty fruitful ground for applying these algorithms. But when you're trying to understand when are we going to get a shift from low rates to high rates, when are we going to get a shift from value to growth, those regime changes are much, much more difficult. And I would say actually now impossible for algorithms happens together.
Okay, great. So those regime changes, I think you guys use the word episodes, I think, that may be difficult for algos to predict, but probably not impossible, right? So, Marius, I'm going to, so growing up, and for myself and understanding asset management, there was a world where there was this sort of gut feel portfolio manager, Mr. Market, understanding the markets where made decisions based on a feeling. In a world where algorithms and data, is essentially king, is the future of asset management more a science now than an art?
So I'd like to believe we've moved on from the gut feeling approach that maybe was the swashbuckling 80s or something like that, and the institutionalization of asset management where clearly scale matters and fiduciary responsibility is something we all take very seriously. So I think the age of gut feel managers is long behind us. Even with somebody like George Soros, who used to say his risk management was when his back hurt, he'd go and cut positions. I think we moved on from that. There's a high degree of analytics that are involved, statistical work, the quantitative nature of asset management has improved, as Dorian mentioned, right? A high degree of quants in hedge fund space and traditional asset management. So I think we've moved on from the gut feel approach. But I think, and I touched on it maybe in my introduction, is that, and I think Gotham mentioned it as well, there's definitely still a space for humans. I think if we look at the CTAs, which Dorian mentioned, investors don't want to necessarily invest in black box approaches. They want to understand what's going on. As someone said to me once, I want to know when it goes wrong, why it went wrong, right? And if you're in a black box approach, it becomes difficult. So I think there's an evolution towards these things. I mentioned earlier the usage can come, whether it be in trading, whether it be in risk management, whether it be in highlighting factor exposures, and behavior. I think is a big part is understanding your team's behavior, both at an individual level as well as at a team level, so that clients especially can see that behavior is reproducible, right? We want to see consistent behavior, consistent decision making, which I think in the qualitative world has been somewhat more difficult. I think once we get the data sets around human behavior, human decision making, and the more data you get, you're going to get a much more transparent portfolio manager and transparent asset management businesses for investors to understand. And that is quite right that should come through. If you're managing people's money and you're a fiduciary. So I think there is still a space, rounding all of those kind of comments, there's still a space to bring that data to bear, bring those decision-making points to hopefully augment the decision-making responsibilities between taking these massive volumes of structured and unstructured data to help us be better at what we ultimately need to do. I'm reminded of airline pilots, right? Where autopilot was first introduced into the airline industry as early as 1917, I think it was, speaking under correction, but it was around that time. It then became really prevalent in the sort of 70s and 80s. And yet today, we still have airline pilots sitting in the cockpit because these weird events happen and somebody still needs to land the plane. And if you think back to Scully, that famous landing in the Hudson River, there is definitely a space for that still to take place, because I think even Gotham would agree, who's clearly an advocate for AI, as we all are, that it would be very difficult for a machine to make that kind of a decision, given that it hadn't happened before. So that event still requires somebody to land the plane, and I think that's why you still have PMs like Dorian and Gotham and I that are able to sit there, even if it is to take the arrows from our clients. And quite rightly, when we mess up, we should.
Right. You mentioned structured and unstructured data, and many of us, we're not, maybe we understand different data types, but from my perspective, and I'm no data science, but so unstructured or structured data is things like pricing data, financial transactions, customer data, CRM, etc. And unstructured data is web data, social media data, media and entertainment, surveillance, emails, etc. Gotham, are we at a point where AI is able to use all forms of data, not only structured data, to enhance investment decision making?
Yeah, so I guess to simplify it, it's data that you can put in an Excel sheet we'll call structured data, and data that you can't put into an Excel sheet we'll call unstructured data. It's not, and the goal with unstructured data is to put it is to convert it into a form whereby you can then put it into an Excel sheet. But yeah, the short answer is yes, we are. So where we can use all of that data in order to make investment decisions. Now, the question that we constantly ask ourselves is, should we be using all of that data? And in some cases it's useful, in some cases it's not. But I'll give you the biggest issue with that, and that is that so a vast majority of data that's been created in the world has been created over the most recent period. So the stats, like 90% of all data was created over the last 3 years. And most of that is unstructured data. So it's things like web data, media, media data, that kind of stuff. What that does is it gives you depth. So you can get very granular about what you learn about a particular company, but you sacrifice breadth. And what I mean by breadth is, how many companies can you get that data on? How much history can you get for that? And that's really important, because when you're building these algorithms, you want them to be robust. So you want them to be very accurate and very detailed, but you also want them to be robust. And robustness comes from observing what kinds of patterns work in different market regimes at different points in history. And if you build models that were very focused on this very granular data, you have a bias towards the most recent periods in history. And so a lot of what we observed last year was actually in this sort of bit of a regime change with rate rising and a shift in styles in the equity market. A lot of quant funds actually struggled. So I'm talking selection funds, not directional funds. Selection funds struggled last year with that regime change because they had built models that were very biased to sort of the most recent period, which had been a growth focused period. And so when that changed, a lot of these models got caught unaware. So you have to balance the two. And focus on the robustness, or accept that they're going to be very recent and have a human being sitting on top to identify where the models might not be relevant.
Right. So I'm still hearing, I mean, the theme that's coming through here is that, yes, we can use AI and the technologies that we have to enhance decision making, so augmentation to improve decision making. But that human being, the intuition, etc., that human element is still important. But and Dorian, I'm going to ask you this question, right? Let's touch on the investment analyst, right? So we spoke about decision making, but let's talk about informing that decision making. So with the advent of revolutionary technologies like ChatGPT, Bard by Google, etc., is the job of the investment analyst at risk? Is it still necessary to have these large research teams that, quite frankly, cost a lot of money, are inputs to the total cost of the portfolio, etc.? What is the role of the analyst going to be in the future?
It's a pretty complicated question. So, I mean, I think where I'm going to try and get to here is that what the best role for AI would be to augment intelligence, so to play with the acronym a bit and to marry the skills of a human being and a machine to produce a better outcome. And I think the best way of looking at that is to start with what AI is itself. So if you take Microsoft's definition, it's the capability of a computer to mimic a human in cognitive functions, such as learning or problem solving. And machine learning then took that a stage further. Computers could learn by experience, and deep learning then used neural networks that permit a machine to train itself. So you're learning by experience, then you're training yourself. And now large language models are training themselves on massive amounts of data with enormous numbers of parameters. And what people are finding is that as you increase these number of parameters, the discovery element becomes bigger and bigger. And so they become more human-like. But if we go back to what we were saying about the quant funds to start with, two factors were driving inflows: low volatility and trend following. And in a sense, low volatility led to trend following, which led to lower volatility, and it kind of feeds on itself. And so one of the big limitations of the sort of AI approach is that, one, the recency bias that Gautam was talking about. Two, what Marius was talking about, the need to correct at turning points or when something really goes wrong. And so as long as trends persist, as long as the data, the recent data, really holds up, you could argue that a pure AI approach would work. But I think the best example of it not working going forward would be fixed income. So if you go back to 1981, bonds have been a fantastic idea, rates have been declining. And it's only very recently that you've started to move the other way. And there's still a huge body of data on the internet that would suggest we're going back to the old world. And so that would steer AI in the direction of bonds have fantastic risk-adjusted returns, allocate to bonds. But looking forward, looking at inflation, looking at the changes, and looking at the interaction of AI on growth itself, which I don't think AI is at the stage of analysing itself yet. These are the kind of areas where you need the interaction of humans. And to go back to the analysts, which are becoming progressively less expensive, by the way, they are definitely necessary as a check. So the way that we use them is to define a universe through AI, because we can set characteristics and it control very quickly. But then we check the results, check the recommendations against what the context the fundamental analysts have, which you cannot replicate purely in linguistic terms that are then transformed into numbers. So it's the context and the sense checking, which effectively you avoid accidents that way. Gautam talked about it in terms of going for the second best stock or the third best stock, not crashing the portfolio. And these elements will always be there. You know, we thought about Ukraine, we think about whether inflation's really a big issue now. Looking forward, you know, there's a rumor that China may put pressure on Russia to have some kind of truce in Ukraine. China may change the way it runs its economy. There are so many uncertainties which cannot be in the data already. So the fact that the data is not complete and that the interpretation of the data is therefore imperfect creates a role for fundamental investors.
Great, thanks for that. So absolutely. So we're saying that, you know, the role, just getting back to the question, so while the traditional role of the analyst you know, is still required, that may the actual specification of that job might change, and the way in which they use data. Fantastic. Marius, so last question on AI before we move on asset allocation. You know, the South African investment opportunity set, you know, is pretty small and is decreasing. I think I saw something on an article about the JSE yesterday actually speaking about this, and then why the SA stock market is shrinking. So my sense is that AI is more suited to global investing, where the data set is much larger, the opportunity set is much larger. So is AI something that is more applicable to global investment management as opposed to SA?
So I need to be careful what I say, because Radhima will come through the screen at me. But I think no. I think there's no. Let's not beat about the bush. The equity market in South Africa is becoming smaller and smaller and less liquid, and especially for large firms like ours, and many of the other household names in the industry, it is becoming a little bit more difficult to deploy capital efficiently into the markets. That doesn't change the decision-making process and the benefits that quantitative skills and data science and AI can bring to the decision-making process. And hopefully I gave you some examples earlier around that. That said, there's no doubt that the breadth of opportunities offshore, be it in credit, be it equities, be it factor exposure, geographic exposure, news flow, can certainly be of more use, of more scale in the offshore context. But that doesn't diminish the value add that AI can bring to the table, even in a South African context. I think it's how you harness it, how you use it, and clearly we're in a new paradigm post the advent of ChatGPT and the prevalence of AI in consumers' mindsets and consultants' mindsets, and yours as an allocator of capital. You're going to make sure that you're asking me this question: what are the investments that we're making? How are we training our team? The transparency of decision making, which I alluded to earlier. All of those things are still relevant in the South African landscape. They don't go away.
Absolutely. I said I was going to go into asset allocation now, but forgive me. I see Paul Reed as a more of a comment that came through and says, what concerns me is that someone releases a viral AI that starts to operate and evolve for its originator's benefits. Now, I mean, while what I take out of that is probably alludes to what some of those headlines said this morning, in these global news agencies about the impact of AI on humankind, etc. And we need to be mindful about how how it gets deployed going forward. Maybe Dorian, do you have any sort of just views on that? AI to the next level, the concerns that are being shared by these tech giants.
Yeah, so I mean, I was informed today that on the Today programme, which is a very kind of staid, fairly old-fashioned, dusty BBC programme, they were talking about it. So clearly, it's everywhere. I mean, the trite answer, the simple one, is fantastic if the organisation is us and we can gain dominance over JPM or whoever. That would be great. But if we think about it more seriously, the question is, what can you do? Because I've seen a kind of suggestion that there should be a 6-month hiatus, a 6-month stall on all AI development activity so that regulation can come through, because the problems are about regulation, they're about discrimination, they're about impersonation. The fact that, I love this term, AI can hallucinate, which basically means it makes up facts and confidently presents facts as truths, quite like some analysts in my experience. But it can also make up citations. If you think about what that's like, it's like an autocratic regime. And so I would say that, yes, there's concern about this, but if you think about the Soviet Union and its successors, you think about other areas of the world, this is already happening. It's been happening for some time. Whether facts are presented at truth in the US elections going back the last 10 years. So yes, it seems like a belated realization that people don't know where this will end. But I suppose the question I would have, and I mean, it's just based on the experience of regulation of mega cap tech, for example, is that there'll be a lot of talk, a lot of rhetoric, but what's actually going to happen? And more importantly, what can you do about it? Because can you really supervise or impose a freeze on AI development? Because the advantage to the people who break that freeze is enormous.
Absolutely. Cool. Thanks for that. Let's just change the discussion now. So, I mean, fascinating insights around AI in investment management. Let's look at your portfolios and just your general asset allocation views. I'll start. So if we can just have the slide up with asset allocation. Thank you so much. With Gotham, measured against your own strategic asset allocation, M&G is overweight emerging markets. So can you please unpack some of the opportunities you're seeing in the EM space?
Yeah, thanks, Lee. So you're right. I guess there's a large point in which we're modestly underweight broader equity versus our SAA, and within that space, we have an EM bias. And the way to really think about that is the opportunity set as we see it today is fairly balanced. So if you think about the world as being one in which it's biased to either one particular outcome, aka a sort of landing, other one, aka a soft landing outcome, or somewhere in the middle, we think that the probability distribution being assigned to all these outcomes are relatively balanced, and hence the neutral positioning. So the real opportunity, as we see it, is very much within the relative value space, and it's partly tactical, but there's also some medium-term consequences. So if you look at the valuation differential between some of the more expensive markets, and we can tell. So take the US, but actually outside the US, you can look at countries like India and so on and so forth, where the valuation between those markets and some of the cheaper sort of Asia EM and focused equity markets, those spreads are as wide as they've ever been since the early 2000s. So that's the valuation opportunity. And then if you look at sort of the story or the narrative around those assets, people appear to be pretty bearish. I mean, the level of bearishness that I heard about Chinese equities today is almost approaching levels that we saw back in October of last year. We know what happened since then. And then there's the medium-term outlook, which is a big driver of the outperformance of the West or the US equities over the past sort of 15 years has been the earnings delivery. And now a lot of that has been the tech story, but it's not just been the tech story. And if you think about the narrative, yes, there's this whole AI sort of wave that's coming through driving the big cap stocks. But actually, if you think about the societal issues that are coming to the fore, that companies are having to make decisions on things like wage acceptance, the participation of labor versus capital in the output. Those are conversations that are becoming more and more front and center of both policymakers, but also the government more generally and corporates more generally. And as they sort of prioritize things outside of shareholder value creation, as we're seeing, those things come at cost, and typically those costs come in terms of margin. So we think that the setup for earnings going forward is not as kind for sort of some of these Western world corporates. And so that's an opportunity, really.
Thanks, Dorian. Thanks, Gotham. Sorry for that. For just unpacking your view on EMs, which works quite nicely now with Dorian, your view. Or Shodi's view, we're quite negative on EMs. Maybe can you explain that sort of negative or short position, and where are the opportunities in DM? And while you're at it, what's your view on SA?
Wonderful. Best question for last, and thanks for the upgrade on the name there. So if we go to emerging markets, I would say we completely agree with Gotham in terms of valuations. That's clearly the case. And if you go back to October, he's totally right on the extent of pessimism. We had the PMI today; it was depressing. We'll have the Caixin tomorrow in China; that will be depressing as well. That's the private sector equivalent. The problem we have is that there isn't such a big visible catalyst as there was in October. So October it was reopening, and what's happened from an international investor perspective on reopening is it's much narrower and it's much more sort of calm or subdued than people were expecting. It's ongoing. Earnings are improving. We see that with all the companies that we look at. The big PDD just came out, and we see it with hotel groups in China. There are massive opportunities from a valuation relative to their earnings profile, but the catalyst is very hard to see. And secondly, people are scared. People are worried about the potential for a conflict in Taiwan, especially post the US elections, which are now, on the horizon with the debt ceiling. I think that's brought people's attention to that space. If we look more broadly in emerging markets, it's interesting because emerging market local we do like. I'll come back to South Africa at the end. Hopefully I'll run out of time by then. But the yields are attractive. There's a rate cutting cycle ahead of us. Emerging markets raised rates well ahead of developed markets. They're at much higher rates. They're actually high in real terms, which if you look at developed markets and you use the right kind of indicators for inflation, it's very arguable that not many developed markets are particularly tight in real inflation adjusted terms. So that's something to think about there. But the catalyst would be the dollar beginning to depreciate after tension and yields being high. If you move into the hard currency space, which is obviously relevant for you as South African investors as well, you look at the dollar space, it's a bifurcated, it's a split market. So the high quality end is very expensive and very interest rate sensitive, the IG part of EM sovereigns. And the high yield part is very high yield for a reason. There are a lot of restructurings, there's a lot of stress in the system. So where we see credit problems in this cycle is actually in emerging market sovereigns that were kind of on the edge, and they have agreements with China through the One Belt, One Road. There's a lot to kind of unpack there. Moving on to developed markets, I think, as I said at the beginning, you know, we are unusual for an income fund, especially the representative one you have there, in that we think that US will persist. We think that margins will improve for the mega-cap tech. We think that earnings are okay. And if you look at it on a free cash flow basis, multiple basis, actually these companies are not that expensive. They're producing a lot of cash. And we think AI will help that process. I mean, one of the biggest ironies and one of the more depressing things about AI in many ways is it's very expensive to do well. So the latest iterations of large language models cost an awful lot. That's why NVIDIA is up through the roof, through $1 trillion valuation. But it also means that large companies have a massive advantage because they can make the investments that small caps can't. So that's on the US side. On Europe, we see an opportunity simply because projected earnings growth in Europe is about 6% for the next 10 years, long-term projection, let's say, and 8% in the States. But the multiple difference between the US and the European markets is much greater than that. So simply looking at where the markets are going and how they're priced, Europe looks good. But the real one that stands out is Japan. For the first time, I mean, I've said this last in 2012, I think. And here you have an opportunity on a high yield, better shareholder returns pushed by the government, inflation being a good thing for a market, which is very unusual. And so we see opportunities there. Final thing I'll leave you with, and it's not so much in a defensive strategy, but more in our sort of thematic punchy one. We think convertibles could be a big winner, convertible bonds. And so it goes back to my sort of previous days in Singapore and Zurich, simply because convertibles allow companies to issue capital, to raise capital with low financing costs now and potential dilution in the future if things go well. And I really can't think of anything else that suits this environment of uncertainty so well. So the big surprise could be a renaissance of convertibles, just to give you a cliche. I've run out of time for South Africa.
Yeah,
but
I'm going to spare you on the SA comment. So Marius, just to finish off quite quickly, your asset allocation looks really interesting. This just is your global cover, but maybe more specifically, quickly, Rand blowout impact and your use of currency hedges. Maybe in a minute, if you don't mind.
Yeah, look, Lee, this just so the audience knows, I mean, this is an absolute return fund that we're showing here. It's not necessarily representative of our more multi-strat approaches and our balance funds that we've recently taken over. You know, the low degree of equity exposure here is really, given the fund has done incredibly well. We've captured almost all the upside of certainly more than South African equities over the last 12 months. We've captured an enormous amount of global equity returns at a much lower degree of volatility. So Sharpe ratios are great. And our job first and foremost is to protect clients' capital. It's slightly different to Schroders and M&G who you're showing here. But, you know, clearly the blowout in currency is interesting from the perspective of people who are so vocal around currency hedging. We like to hedge the currency because if we want to bet on the currency, we bet on the currency. If we don't want to bet on the currency and we want to have exposure to bonds, high yield, investment grade, convertibles, you know, Asian high yield is an example that looked like a fertile opportunity 12, 18 months ago. Those are allocations and positions we want to take at a granular level. We don't want the risk of that position being overwhelmed by the currency risk. And hence we want to hedge out that currency to ensure that the exposure we're taking is ultimately the exposure we want. Now, to bring it back to this point in time, where things have changed in South Africa. No doubt over the last 5 weeks, the foreign policy, which was wobbly already, given some of the statements that were coming through around the non-alignment towards Russia, have taken a step up. And yesterday, another step up, right? And therefore, while we would still like to currency hedge, The adjustment that we would take is how we do the currency hedging. So we run dynamic strategies in terms of currency hedging, not just forwards. We trade a lot of optionality around that. It's a deep liquid market in South Africa. The Rand is a deep liquid market and used as a proxy for many emerging markets. But we'll just adjust the way we take that currency hedge, which means it's not as lucrative longer term for us. The carry that we can harvest from that currency hedge is not necessarily as lucrative as it has been. But we would still be inclined to currency hedge, especially in a world where people are moving. And I think it was mentioned earlier by Carl that many of your managers are shifting slowly towards increasing their offshore exposure towards the 45%. I don't think they'll ever go to 45, but because they're going to want to overweight and underweight. And we would agree with that view, and we've been on record of saying that, and we've been doing currency hedging for 10 years. So it's a way of controlling volatility, much more prevalent in this strategy, which is an absolute return strategy. If the Rand strengthens and you have 40% offshore, all of your bottom-up stock picking, all of your top-down views around geographic allocations or asset allocation is going to get overwhelmed by the Rand move. We don't want that. We want to control that specific exposure. So that's the reason for currency hedging.
Thanks so much, Maurice. Look, we have to end the conversation. Jens, thanks so much for your time, your views. It's been fascinating. Next up, please, to all the advisors, please stay on. There's a really cool section around that Wasim Abrams, our head of distribution, is going to have with Evan Bars. So Evan is the partner that runs NMG Consulting South African operations across life insurance, wealth management, and asset management. And in addition, Evan has worked across NMG's Australian and UK offices, allowing for international comparisons within the SA markets. Evan has some fascinating views and inputs for financial advisors around what's happening in SA and sort of what's best practice at the moment. Thanks, Evan and Wasim.
Well, thanks, Lee. Evan, great to have you with us. So looking forward to chat today about the trends you see playing out in the financial service industry. Maybe to kick off, can you give us a bit of an overview of NMG, the business, the work your team does, and just your role in the team?
Perfect. Yeah, sure. Happy to. I'll quick one, not trying to sell anyone anything, but just for context. So we're a strategy consulting firm. We operate across, as mentioned in the introduction, a few different markets that might be relevant for people in South Africa. So in Australia, which is actually where I started out my career, US, UK, the office I work for, I work for the London office, and of course, South Africa. I think what's interesting about NMG is South Africa is a core market for us. We're founded by 4 South Africans, 30 years ago. So it's remained very core. I'm the partner that runs the South African business. So whatever studies, whatever projects we run out here, I'm involved in generally to some extent. And for today, I think what's relevant is that in the South African market, each year we will interview a few hundred different advisors, some on the life insurance side, but a lot of that's on the investments side. And we also do those same studies globally, right? So we can compare some of the trends we see here to the trends that we see in the advice landscape in, say, the UK, pre-post IDR, etc. And so we might, pull in some of those comparisons.
Cool. Thanks for that. So through the research and studies you and the team have done so far, what are the biggest challenges that you are unearthing out there that advisors are facing today?
Sure. So we have this one question we ask, which is, what keeps you up at night? And that's typically a good one to get an idea of what are some of the challenges that advisors are facing. And look, the one elephant in the room is that there's political landscape, right? Political risk, etc. But if we look at some that have kind of clearer solutions or advisors are kind of taking steps to address, the one that's really coming through a lot is around regulation and compliance. So just increasing compliance burden is one of these big challenges. And so, look, it's a challenge and it's expensive for large firms as well, but it's really the longer tail of advisors that seem to be under the most pressure to just try and keep up with all of the developments coming through. And so some advisors are telling us that we're spending more time on compliance than actually seeing our clients. And it's not because they want to, it's obviously not an ideal situation. And so that's a challenge. And that kind of increasing cost, unfortunately, also comes with reducing revenues because advisors are therefore saying, well, we can't work with as many clients. And so whether it's explicit or not, we're starting to see the number of active clients come down. And we saw the same thing in the UK pre-post IDR was, drop in number of active clients, increasing advice gap, fewer clients actually getting advice, which is a challenge. And of course, it's the wealthiest 200 or 300 that remain. So it's also a challenge, especially in that kind of lower income space. So the regulatory landscape compliance burden's one. And so obviously focus on efficiency is going to be a key one. How do I make this more efficient? How do I keep as many clients as possible? And then another one that we've seen come through is really around succession plans. So most advisors will tell us they've got a succession plan, but some of them do sound draft, right? Including, as an example, an unwilling family member, right? So my son's giving my succession plan, but he wants to study arts and move to London. So it doesn't sound like it's a full formal, succession plan there. Interesting, just to close out, interesting point is bringing in a successor at the same time as having challenges in working with all of your customer base. Actually quite an interesting synergy there. What if we bring in a successor, give them the long tail 100, 200 clients we can't fully service? Maybe it's an interesting time.
Okay. So on the back of that, how are you seeing advisors' practices evolve?
Yeah. So, it's potentially going to be obvious when I mention it, but technology, right? So we've been keeping track over COVID period, and since then, what are advisors implementing? And different advisors starting in different areas. But if you kind of squint and step back, there's some trends that we can see. So efficiency is a big one, and so that's mainly the back office tech side. It's some of the elements around firstly just standardizing and cleaning it up, but also things like establishing a CRM, maybe even automating client onboarding. But what's interesting about the tech side is the efficiency pieces there, back office mainly, but we're also seeing some kind of professionalization in terms of the way that the front end looks. So what I mean by that is things like an advisor's website, right? Or visualizations in the advice or client discussions, right? Things like flight paths. And as an extension of that, also reporting. So actually some of the tech angles, it's great. The efficiency side's there, but also there's angles around, how you end up dealing with the clients and how professional the firm ends up looking. And then I think outside of that, just back to the efficiency point, we didn't really mention it's not necessarily tech related per se. And it's also not the last couple of years, it's been a trend for a while, but centralized investment propositions has been the kind of clearest trend. We've almost stopped showing it in graphs. It's kind of been a clear trend for a number of years now around efficiency.
Okay, so two things around from your answer there that I'd like to understand a bit better. So one, firstly, what tech is critical for this evolution path? AI is all the buzz. We heard the investment managers just before the chatting about it and the impact on investment management itself going forward. How are practices are positioning themselves to take on tech, and what tech are they looking at? And then secondly, based on your last comment around the shift you're seeing to centralized investment propositions, maybe you can unpack that a bit more for us.
Yeah, sure. So on the tech side, firstly, look, I wish I could tell you there was all this really interesting AI integration that's coming through in advice practices. I think maybe in a year, it's moving so quickly. Maybe in a year, we'll have a couple anecdotes, just as examples. But really what we've seen over the last year, 2 years has been the base, the fundamentals. You can probably make it that it's hard to move into the exciting things if you don't have the fundamentals, right? So what I mean by the fundamentals, it's more basic functions of running a business, managing a client base, mentioned earlier, CRM, advice tools, reporting. It's more around that framework. And so, there's examples, right? Your Xplans, your Elite Wealth. These kind of businesses are the ones we're seeing kind of usage in that space. I think a couple points based on what we've seen from advisors. One is have a picture of how it's going to come together, because some advisors get quite excited and kind of pull in this, pull in that, pull in that. You end up in quite a complex space. They don't speak the same language and then can't integrate. You might end up with less efficiency than when you started. And then the other one, which kind of links to that's around, it's all in the implementation. The same software, well, not all, but a lot of its implementation. The same software will be said by one advisor to be the best thing ever for them. The next advisor can say it's terrible, doesn't work for me. And some of that comes down to implementation. Just on the centralized investment proposition, I didn't really define it well. So I think working backwards from where were we a few years ago, and pre-IDR in the UK as well, was advisors would fund pick for a client. Client walks through the door, advisors would look through a range of funds and build something to the needs. Generally, with advisors focusing more and more on holistic advice and trying to kind of double down and professionalize further in that direction, we found that they've started to look also for efficiencies around that investment process. And so what we're really finding is first step is kind of shortlist, but mostly when we talk about centralized investment propositions is things like working with DFMs and setting up model portfolios, and kind of saying, you've got to be the expert in this space while I'm going to do this, right? I'm going to focus on the advice elements. I'm going to go find new clients. So, if I have the space, I'm going to do these kind of things there. So at the end of the day, look, the advisor gets to do largely what they want because they're clients. And there's some, very impressive practices that do still fund pick, but increasingly it's minority.
Okay, your response talks directly to something we unpack quite a bit through our DFM multiply effect. Specifically that practice alpha. So the efficiencies, centralized investment propositions or DFMs bring to the table. So I think it's safe to say that the role of a DFM is becoming an important component in relation to the financial advice given or rendered to client?
Yeah. So in the last year, we've been asking each year for, I mean, I've been doing these interviews at least for kind of 8-9 years. And last year was the first year where the majority of IFAs we spoke to work with a DFM now. It's 52%, but it previously was only the big firms could, and DFMs didn't really speak to this, lower end, longer tail. But increasingly, we're seeing more and more take up. And yeah, we ask advisors to rate how important the DFM, the platform, and the asset manager is as a partner to them. And DFMs come through first consistently, typically at around a 9 out of 10. And what's interesting is that some advisors do position the DFMs actually to their clients, not as a separate business, but as an extension of theirs. So this is my investment partner. And I think back to an earlier point around professionalization is that can help sometimes, right? Is I'm a larger firm than just kind of one advisor, is actually here's my investment team.
So like a broader value proposition they take to client. Okay.
Yeah.
So I mean, just on that, I mean, you mentioned LISPs. Just the LISP space and the evolution of that. I mean, historically, LISP had been an important component in advisors' practice, considering that's where they execute advice and are quite reliant on the development of these platforms by product providers. I mean, maybe take us through what's happening in that world a bit.
Yeah, sure. And look, I think this is one where the UK is a good comparison point because we've seen a similar journey play out there. And I think right now, or at least historically, platforms in South Africa have really been just fund supermarkets, right? You log in and look at a range of funds. And so selection, when we ask advisors, how do you pick a platform? It's really just been around, well, do you have the funds I want? But then don't mess anything up, which is service. And then I want good pricing, right? We think that that's fine. But increasingly, I mean, DFM functionality becomes important for the reasons mentioned. And then the other one, linking back to the tech investments advisors are making, is around tech integration, right? And I think it's important is that historically, or even today, LISPs are quite a distinct or separate part of the whole process. But if advisors are investing more and more in back office, we expect and we're seeing demand for integration between that. And so, how does the LISP fit into the advisor's world as opposed to the advisor having to fit into the platform world? And so, for example, in the UK, the majority of advisors, when we interview them, they tell us, I have at least some level of integration between my back office system and the platforms I work with. And sorry, final point, just an interesting one is at the moment in South Africa, you kind of got local platforms and offshore platforms as these completely separate propositions. It seems obvious to us that those two will increasingly come together and we're going to have kind of a holistic multi-currency platform space.
Cool. And final question, just in the interest of time, what are the major threats you're seeing many advice businesses are grappling with at present? Sure.
So can I answer with one threat and then one thing that we don't think is a threat but is often cited as one?
Yeah, go for it.
Okay. So one, we do think wealth transfer between generations is a potential challenge. It's coming, right? So complex process. It also means the advisor is going to have to extend relationships. Some already do, but some do not. And you got to extend to spouse, to children, etc. The deepening of relationships, while it's great, does also put further challenge on the client count problem we talked about earlier. And it also links to the tech side, right? Is your CRM up to scratch? Like, are you ready to kind of be dealing on this kind of basis with all of the various families? It does have the potential through wealth transfer to take quite a big chunk of assets out of the advisor's asset base, which is not great. But on the flip side, also could secure your value with the next generation, kind of bring it top of mind, which leads us nicely into what we think is not a threat, or perhaps an overstated threat, which is the direct-to-consumer or the non-advised space. So with improvements in AI and robo-advice and all of that, I mean, certain advisors do tell us we're concerned the next generation is not going to use financial advisors. Our view would be that the role for advisors does remain as important as ever, but that the role is going to change. Right. So I think if you link back to some of the previous themes, if your role is fund picking, right, then maybe robos can be a threat. Right. But if you're a holistic advisor, you work with our family, you're discussing intergenerational wealth transfer. I mean, even if AI could give you the right recommendations, would you opt for it? Would you believe it? I mean, it excludes the human emotional elements of advice. And I think it was mentioned in an earlier point, was it the, I forget the name, but ChatGPT can be confidently wrong, right? So AI can be confidently wrong. Yeah. And I think that's the challenge right here is they want to have the human element. And so same thing with younger clients, right? And I speak from experience here going through the journey was when you don't have any money, it's easy to be non-advised. And if anything, it kind of feels like a burden to speak to an advisor and say, look, I've got 10 pounds, right? You're wasting their time. But our view is that as the amounts increase and as the decisions become more complex, there's going to be a similar take-up of advice. And so obviously inheriting money counts in this space. So overall, and so it's been a real rush through, but overall, I think we're positive around the future of advice. I think it's going to keep evolving though. And so I think the big question for us for advisors would be, are you set up right? Do you have the right partners in business? Are you set up right for this evolution? Because it's going to keep changing.
Okay, Evan, thanks for the insights. I'm sure everyone on the call found value in what you had to share with us and something to think about in terms of their practice and how they're positioned. And then thanks for everyone taking time out to listen to us this morning. And with that, I'll hand back over to Lee.
Thanks, everyone. And thanks, Evan. Thanks, Wasim. Time to close the webinar. Guys, thank you so much for joining us. It was an absolute privilege to have you here today. We discussed the impact of artificial intelligence, not only in the investment management industry, but on advice as well. But I think the message that comes through quite clearly is that human element is always going to remain important, and particularly for advice. So, with our proposition, we make sure that we enhance not only through technologies and humans, our investment alpha for you and your clients, the practice alpha, so that you as an advisor can ensure that advice alpha that you give to clients continues to add value going forward. So guys, thanks. We'll see you in August for the next quarterly webinar. Keep well, keep safe. Goodbye.
Innate is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.